Hi, my name is George Dagnino. I'm the editor of the Peter Dack Portfolio. There are many ideas on why the economy should be in a recession and instead why the economy is strong. The data are weak, but you look at the government statistics, GDP is growing at 2.8%. It's huge. So the market is confused, investors are confused, and there are bearish views and there are bullish views. So what I'm going to do in this video is look at the very six simple graphs that show you the trend of the market and the bearish case and the likely bullish case. Then at the end of which I will give you my opinion what I think is probably going to happen, because so far roughly I've been on the right path using our business cycle indicator, which has a nice batting average. So let me look at it. Well, the most simple reason why this is a bull market, because clearly the trend is up. There is no way. Look at the 200-day moving average, and the market is above this average. Yes, people say this is too far ahead of the 200. This is also 200, and everybody turns out to be bearish, which eventually they're going to be wrong. Now, by the way, we have a technical timing indicator which has been outperforming the market. Is very simple to use with the 200-day moving average, and it's very simple. It tells that at the end of the month, if the S&P 500, as of the closing of the end of the month, the S&P 500 is above or at the 200-day moving average, the is a buy, is a bull market. So this is a superb performance. We publish the performance in every issue of the Peter Dack Portfolio. But anyway, the bottom line is this is a bull market. Now, what other indicators are we are looking at to see that is a bull market? By the way, notice how the market bottomed towards middle to the end of 2022 and started rising. What happened at the bottom of 2022? Let's see. It's very interesting. The bullish case is based on a very simple trend, and it's the trend of short-term interest rates. Forget about the Fed, because by the way, the two-year yield preceded by a year and a half the action of the Fed. So that's why I look at the two-year yield. And when the two-year yields rise, like it happened here, the stock market did not do actually decline in 2021, 22. But then what happened towards the middle of 2022, short-term rates stopped rising. And sure enough, this is when there was a bull market. So the market liked the fact that the economy reached a stable state, short-term interest rates stopped rising, and that was a good sign, a bullish sign for the stock market. But there is something else, though, that is moving the stock market. Let me show you. But there is something else that is moving the stock market, and that is risk and liquidity. What is a good indicator that gives you a sense of how much liquidity there is in the system and how much risk is perceived by investors? Yes, you're right, the yield spreads. The yield spreads is the spread between yields of lower grade bonds and treasuries. When the yields is low, investors perceive low risk in investing in low grade bonds. Why do they don't see risk? Because there is a lot of money around. So they say everything is safe. But when the spreads rise, that means there is less liquidity, business that needs to borrow in the high yield market is having problems. Interest rates are rising relative to treasuries, so there is a sense of risk. In fact, if you look at this chart, again, when do you see the market declining? When the spreads were rising. When did you see the bull market going through the roof? When the yield spreads declined. So the bottom line is yield spreads rising is bad news because there is risk and lack of liquidity. Chances are in that period, as we saw in the previous chart, interest rates are also rising. When instead the yield spreads decline, it means that investors perceive less risk and interest rates stabilize. And this is the bull case, basically saying interest rates are stable, possibly even going down. Yield spreads are low, trending down, fairly stable. There is liquidity, and this is a classic bull market environment. Now there is the bear market. So let me see the case for the bear market. The bearish case is based instead of the trends in the business cycle. And let me show you why that is important. This is again is the S&P 500 from 2000. And if you notice here that there is a 4-year cycle that is very clear, 3.5, 4 years. And then it goes up and it comes down. So you have 4 years, you have 4 years, and then you have 4 years. And by the way, this cycle, I showed in another video, exactly to the date, is exactly synchronized with international foreign markets. They have exactly the same cycle. So let's see how that is important. Besides, there is another thing, that the stock market rises because earnings are going up. So if the market has the cycles, it seems natural that also there is a cycle in earnings. So let's see if that is true, because then our indicator, business cycle indicator, can be used to forecast where earnings are going, and therefore we can forecast the market. The timing is exactly the same. Let me show you. This chart shows the growth in earnings, and the data are provided by stockcharts.com. And what I did, I computed a rate of change over 4 years, and there is a nice cyclical pattern, very, very nice and very, very smooth. Again, is over 4 years. And the market tends to strengthen when earnings rise, like here or like here. But when the earnings slow down, like here and here, then the market pauses. So the question now is, where are earnings going to go? Are they going to turn around, and therefore there is going to be a bull market, or will continue to go down? The next chart will provide the answer. This chart puts it all together, and I rely quite a bit on this chart because it's been right in the past. Now, what you have at the top panel, you have the S&P 500. Here you have the growth in earnings. And as you can see from here to here, for instance, the market has not done anything because earnings slowed down. From here to here, the market has not done anything because earnings are slowing down. Earnings have been going up recently since 2022, but now they're sort of faltering. Again, these are data. I don't express opinion, the disaster, the world deficits, and all that. These are the data. So now the third chart at the bottom is our business cycle indicator that we print from, we derive from market data. It's not economic data. Market data is the market telling us what the economy is doing, and has a very precise pattern, very precise. Every 3.5, 4 years, there is a bottom. We go back as far as we could go with the data provided by stock charts, and every 3.5, 4 years there is a bottom, and it roughly goes up for 2 years and declines for 2 years. And so, for instance, what it is saying from here to here is 3.5, 4 years. The same thing from here to here, and guess what? Now it's telling us if you put the 3.5, 4 years, it comes out that in 2024 there is a peak in the business cycle. The same thing can be said at the bottom. You see, from here to here, from bottom to bottom, there is 3.5 to 4 years. So if you put 3.5 to 4 years from 2023, 22, you end up to 2026. So somehow this curve is going to like this. Of course, you say everything can happen, but even the COVID did not change the pattern. So this chart is driven by business decision and possibly anchored by the presidential cycle, by the way. Anyway, what is this chart saying now? What is the business cycle indicator? What is this graph at the bottom of the chart? It's saying that the business cycle has reached a peak, meaning that from this point on there is likely going to be a slowdown that is going to last until 2026. Now, why is that important? Because the growth of this graph here, or the business cycle, helps to tell us what earnings are going to go. You see how earnings follow very closely the pattern of the business cycle indicator, which makes a lot of sense. When the business is growing fast, companies make more money. When the business slows down and the business cycle indicators show that, then business makes less money. And of course, the stock market doesn't reflect all this. So what am I saying? I'm saying that the business cycle indicator at this point says be cautious. And the strategy, we have several strategies based on short-term trading, basically a few weeks to a few months. They're being very successful, actually. So I hope that you will look at them. Okay, let's see what's next here now. I realized that the market was, let's call it uncertain. I know it always is, but this is close to a turning point. So it's more uncertain than other times. So what I decided to do is to come up with a new investment strategy. And I said, look, if you start buying in fundamental and be long, you're going to get hurt. Because again, at a turning point, you get turning hurt. And you see what happens to recently to technology stocks and semiconductors. So, sorry. So let's have a different strategy. A strategy based on shorter term. So shorter term means 2 weeks to a few months. And based on 3 basic concepts. One is relative strength. Why relative strength works? It's not a relative strength index that people use, the technical indicator, but it's the ratio between the price and S&P 500. If the price of the stock goes up, means that the price is stronger than the market. If instead the ratio goes down, means the price is weaker than the market. So what you want to do is buy stocks with rising relative strength, that is stronger than the market. By the way, experience shows that if you buy those stocks and there is a market decline, those stocks will decline less than the market. This is a very interesting feature. Now, why relative strength works? It works because big money has much better knowledge than you and I. They know exactly what is happening to the companies. They are being briefed by the chairman of the boards, by presidents, by marketing strategies, by marketing vice presidents, pricing. They know everything. They know everything. They see the projection of the company over the last 10 years, what is the vision of the company and all that. You and I will never be available to get that kind of information because companies give that kind of information only to big money, say Fidelity or Vanguard, for instance, among others. So these people know things way ahead of us. But why? How do we find out that when the relative strength declines? You see, you can see the stock going up, but you see the relative strength declining. What does it mean? It means that the people who know are beginning to sell. And chances are you see volume slightly increasing, and you see the relative strength decline. The price is going up, but the relative strength declining. So that tells you the people in the know are unloading. Rising volume, you got to get rid of that stock. That's as simple as that. I don't think about emotional things. That's it. It's a rule. Finished. The opposite is also true. In other words, when the stocks goes down, and now you're beginning to see the relative strength rising, right? And then you see now the stock turning up, and you see heavy volume, much heavier volume coming in, that means that people in the know, they know that there is something positive going on for that company. That's the time to buy. So these are the two basic ideas besides buying a stock and selling the stock, using relative strength, price trends, and volume. And this, by the way, has done excellent results for me. I publish it. My subscribers have it advised every time I place an order, and they know exactly the performance is widely available because my account is the portfolio is with Schwab. Schwab provides all the statistics about the transactions, and believe me, I'm not telling you what they are because otherwise it looks like I'm overselling the point. But they're really good. They're really good. The returns on the capital invested, I'm very pleased with it. So as far as there is uncertainty in the market, I'm planning to follow this strategy. I hope you will become a member of the Business Cycle Academy. We have 3 levels of memberships. One is with videos only, like this one. Every time it's published, you are notified and you can see it. The second membership is with video, and every time there is an economic news or financial events that need to be that are important, I write always a note and send it to the members of membership type 2. There is a third membership, and they receive the Peter Deck portfolio, which is a 22 pages twice per month research from economy, financial markets, and international markets and their trends. And of course, all the economic and financial updates, plus, of course, the videos. Thank you for watching this video. And please, if you found this content valuable and want to dive deeper into current market trends and all the investment strategies that we use for bonds, stocks, gold, the stocks recommendations we make, please do join us. Your support is very important so that we can provide high quality content on the business cycle, trends, and how prices and investment strategies are affected by changes in the business cycles and the various indicators that drive it. Thank you very much again for following, and please, I hope to see you really soon. So long.